metal box, 4 walls, a roll-up door. No plumbing, no electricity in most units, no employees standing around waiting for a shift to end. On paper, it looks like the laziest asset class in American commerce. Buy dirt, pour concrete, weld some corrugated steel into rows, collect rent from people too lazy or too sentimental to throw their own belongings away. Here's the paradox. The average self-storage facility runs somewhere between 70 and 80% operating margin, higher than software companies, higher than luxury hotels, higher than almost anything you can legally build with a shovel and a permit. And yet, the largest wave of self-storage bankruptcies in the last 2 decades didn't come from empty buildings. It came from full ones. Understand that, and you understand the entire industry. Tier 1. Bootstrapped. A single-story facility in a secondary market. Think a mid-sized town outside a growing metro. Land, construction, and permitting run somewhere around $800,000 to $1.4 million for a facility with 200 to 300 units. Owner-operated. No staff. A keypad gate and a Facebook marketplace listing do most of the marketing. Tier 2. Regional. A multi-building, climate-controlled facility near a suburban corridor. 500 to 800 units. Drive-up and interior access combined. Capital requirement climbs to $3 to $6 million, usually financed through an SBA loan or a regional bank construction note. This tier hires a part-time site manager and starts competing on amenities, climate control, keypad-coded individual unit alarms, 24-hour camera coverage. Tier 3. Institutional. This is where the public REITs live. The public storages, the extra spaces, the CubeSmarts of the world. Portfolios of hundreds of facilities, acquired not built, financed with securitized commercial mortgage debt, run through centralized revenue management software that changes prices by algorithm, sometimes daily. At this tier, you're not buying a building. You're buying a cash flow instrument that happens to have a roof. The mechanism that makes all 3 tiers work is something the industry calls asymmetric price elasticity, and once you see it, you cannot unsee it. Picture a subscription you signed up for 18 months ago. You forgot the price. You forgot half of what's even in the box. Every month, the charge hits your card and you barely notice. Storage operates on exactly that psychology, except the box is sitting in a warehouse 40 minutes from your house, filled with your dead grandmother's china and a treadmill you used 4 times. The insider term for this is sticky occupancy. Once a tenant moves belongings in, the physical and emotional cost of moving them out again, renting a truck, finding a free Saturday, confronting what you actually own, is almost always higher than just paying the rent increase. Operators know this, so they price new move-ins aggressively low to win the customer, then apply what the industry calls existing customer rate increases, or ECRIs, quietly raising the rent on tenants already inside, sometimes 8 to 12% a year, far above what a new customer would ever accept walking in cold. Here's the counterintuitive fact that violates normal retail logic. The goal is not to keep the facility full of engaged, satisfied customers. The goal is to keep it full of customers who have stopped paying attention. A facility at 95% occupancy with tenants who never call, never negotiate, and never leave is worth more than a facility at 95% occupancy with price-sensitive tenants who shop around every renewal. Now walk the physical site. The layout looks accidental. It isn't. Drive-up units sit closest to the entrance, the ones customers see first, the ones that rent fastest, and the ones priced highest per square foot despite costing the least to build. Climate-controlled interior units sit deeper inside, requiring a hallway walk past, deliberately, a wall of moving supplies for sale. Boxes, tape, mattress covers, all marked up well above retail. The corridors are narrow. Fluorescent lighting stays dim in interior hallways, not because it's cheaper, though it is, but because dim, slightly disorienting hallways make units feel more secure, more vault-like, more worth the premium. Gate codes and individual unit alarms aren't primarily security theater for the tenant's benefit. They're friction. Every added security step is one more reason a tenant, months from now, will decide that canceling and physically emptying the unit is more effort than it's worth. The hidden liability sits in the concrete itself. Roofing, HVAC and climate-controlled buildings, and fire suppression systems age on a schedule most first-time owners never model. A facility that looks flawless on a rent roll can be carrying a $500,000 roof replacement sitting quietly 5 years out, invisible in the pro forma. Very visible the day it starts leaking onto a unit full of a tenant's belongings and the insurance claim lands on the owner's desk. Which brings us to why full facilities go bankrupt. The first collapse pattern is capital structure. In the 2008 downturn and again in isolated pockets during the 2022 to 2023 rate hike cycle, a wave of regional operators who had financed acquisitions with short-term, variable rate commercial debt got caught when refinancing came due at triple the original interest rate. The buildings were fine, occupancy was fine, the debt service wasn't. Shurgard's earlier European overexpansion in the mid-2000s followed a similar shape. Rapid, debt-funded growth outrunning the cash flow needed to service it once financing conditions tightened, forcing a retreat and asset sales. The second collapse pattern is market mismatch. Self-storage development follows population growth signals, but supply takes 18 to 24 months to build, while demand can shift in 6. Several Sunbelt markets, Phoenix, parts of Texas, sections of the Carolinas, saw a construction wave in the 2019 to 2021 period, chasing pandemic-era migration numbers. By the time those buildings opened, oversupply had already hit some corridors. Occupancy in newly built product dropped into the 60s, and operators who had underwritten pro forma occupancy assumptions in the high 80s found themselves discounting rent just to fill buildings that cost 8 figures to construct. Both failures share the same root: not a bad building, a bad assumption about how fast money, capital, or customers would keep flowing at the rate the spreadsheet demanded. The final balance sheet reduces to one equation: revenue equals occupied units times rate, minus the rate of forgetting, minus the cost of concrete. Net margin, run correctly at scale, settles around 35 to 45% after debt service. Extraordinary for anything involving physical real estate. Public Storage, founded by B. Wayne Hughes in 1972, built the modern template. Buy land cheap, build boxes fast, raise rent on anyone who stops watching. Hughes died a billionaire, having figured out decades before anyone coined the term that the most profitable tenant in America is the one who forgets what he's paying for. The system was never built to reward the person filling the box. It was built to reward the person who owns it, collects quietly, and waits for you to forget the code to the gate.